Hello everyone, welcome to today's US Open Live webinar. It is Tuesday, July the 4th at our usual time at 13:20 GMT. Only this time US markets are actually closed due to the Independence Day. However, we will host our session as usual. I'm your host, Nikos Zabouras, Senior Market Specialist. Quite a few developments despite the holidays in the US and many more to come during the following days. We will be talking about that. Today, the Reserve Bank of Australia stood out earlier today as it paused its rate hiking cycle again. Other than that, we had seen a Western tech trade wars, EV delivery figures, and Saudi Arabia oil production cuts in terms of other developments. Before we discuss on all of that, please read carefully through the risk warnings and then we will get started. Once again, please read carefully through the risk warnings and the disclaimers. And please bear in mind that anything discussed in this session does not constitute investment advice. Okay, let's get the ball rolling. Let's start with the Aussie dollar and the RBA decision, then we'll move to Euro USD and USD JPY. Before we comment briefly on the Sino-Western trade antagonism that we talked about, the EV deliveries and the latest news around oil production. So we already have the Aussie dollar versus the US dollar in our screen. You can see on the hourly chart. So what we had today was the Reserve Bank of Australia pausing its tightening cycle again, following a deceleration in monthly inflation, for which we had talked about a few days ago, which gave officials some breathing room. However, inflation is still high, wages have picked up, continue to pick up actually, in an overall tight labor market. As such, more moves may be required by the central bank, which kept the door open to more policy firming. The forward guidance, however, was not particularly strong, and the uncertainty around the policy outlook is sustained. The pair reacted lower, but quickly covered those losses, as you can see on the hourly chart here. And that also highlights this vague monetary outlook. Now let's shift to the 4-hour chart. You can see that the Aussie tries to return above the 200 period EMA, which could pose downside bias. Successful effort. However, the upside does not look particularly friendly. The first catalyst would be needed for challenging the next resistance at 0.6818. On the other hand, the monetary policy differential is probably in favor of the US dollar, since the Fed did also stay on the sidelines last month, but its updated projections point to more tightening. And we have seen increasingly hawkish commentary from Chair Powell. We will talk a bit more about that when we examine Euro USD. So this differential is probably unfavorable for the pair, which remains in a precarious position, vulnerable to 0.6563, although the 2023 lows at 0.6456 look distant at this stage. Now let's go to the euro versus the US dollar, which continues to lack firm direction, and of course the lack of the thinner liquidity due to the US holiday does not help. So the latest developments here were the USPC inflation on Friday, which moderated significantly to the lowest in more than 2 years, but core remained sticky, easing only marginally. Now the US economy, meanwhile, beat expectations again with higher growth than expected, while Chair Powell sounded hawkish last week, increasingly hawkish, I would add. On the Eurozone front, preliminary inflation decelerated in a similar, let's say, narrative, but core actually ticked up. The above keep both the Fed and the European Central Bank on track for further hikes and a sustained restrictive stance, and that's why we see this lack of direction in the pair. The common currency manages to defend key tech region for now here in this area we're highlighting, but is definitely very vulnerable to further decline, although 1.0634 is distant. It's not easy to see this being challenged. However, above the EMA, Euro USD has the ability to push for higher highs, but does not inspire confidence for taking out 1.1096. And let's turn to USD JPY. Of course, we're not going to comment on the Nasdaq or any other US indices, given the fact that the actual markets are closed today and also was a half day yesterday. Now on the USD JPY front, bulls remain clearly in control, despite last week's verbal support for the yen by Japanese officials, for which we talked about extensively. There is a high bar for new FX intervention, and even if it does happen, it will likely have limited impact unless the BOJ changes its ultra-loose policy stance. It has shown no inclination to do so anytime soon, while at the same time the Fed has been hawkish, pointing to more tightening, maintaining the policy gap. USD JPY stays close to the pre-intervention highs at 145.9, but the next major resistance at 148.83 looks may prove elusive, at least in the medium term. A pullback now towards 142.50 would be reasonable, although a strong catalyst would be for the 200 period in May at around 150 to be challenged. Of course, once again, we need to reiterate that the US markets are closed today, and it will be interesting to see how US traders return. Now, let's before we talk about what releases we have ahead, let me provide some brief commentary on some of the developments I already mentioned, starting from the EV deliveries figures. Tesla posted record delivery and production figures for the second quarter. This shows that its price cuts are working. They had harmed its profitability in the previous quarter, but its margins are industry leading, allowing it to chase volume over margin. Although delivery production gap persisted, which creates concerns around demand. Markets, of course, reacted positively, and Tesla stock price rose yesterday. Now, China's XPeng and Li Auto also impressed with their figures. Now, on the Sino-Western trade front, we talked about the Wall Street Journal report, but based on which the US is looking to impose new sanctions on artificial intelligence chips to China. A couple of days after that, Netherlands introduced additional export controls to semiconductor manufacturing equipment. Of course, this is important because Netherlands is home to ASML, a choking point in the semiconductor supply chain. The company creates the machinery needed to manufacture advanced chips, being essentially a monopoly. We have talked about and written about this company, a very significant company. And of course, what we had new this week is that Beijing responded to these measures and reported measures by announcing restrictions to the export of metals used in semiconductors. And on the last item we mentioned, Saudi Arabia extended its 1 million barrels per day voluntary production cut into August, while Russia will cut by 500,000 for the same month. This is significant given recent divergences between the two countries. Of course, OPEC Plus has a massive output production cut plan in place, and this is generally expected to lead to tighter oil market in the second half, which is now underway. And what's ahead? What's ahead? We have, of course, on Wednesday, the FOMC minutes. The Fed had paused unanimously on Thursday, but updated projections imply an additional 50 basis points worth of hikes this year. So it will be interesting to get some more color about what transpired during the deliberations and how much opposition was to that move. Of course, there are more to come ahead, like the jobs report on Friday, but we will talk more about that in today's, at our usual time slot, 10 minutes before Wall Street opens. That's it from me for today. Thank you for joining me.